Hello, everybody, and welcome to today's episode of our podcast, dedicated to helping first home buyers in New Zealand. I'm Andy, your host, and today we're joined by Anna, an expert advisor in home financing. So, Anna, often we get asked what bank is best to work with. The simple answer is really depends. In this episode, we're going to break down the banking basics so you can make a better informed decision. First, we'll cover the banking servicing calculation, which is effectively how they calculate how much you can borrow. We'll also cover the three major differences in that calculation that would change your results based on the bank in which you may go to. Finally, the key differences between bank interest rate pricing and what we may be able to get. Now, as a bonus, we're also going to touch on the benefits of considering a mortgage broker over a bank. So let's dive into it and demystify the mortgage process for first home buyers. So Anna, first up is the servicing calculation and understanding that. Could you please start by explaining how the borrowing calculation works with banks and what they look at when they see a client and how to utilize this information?
So when we talk about servicing, we mean how does a bank assess us and determine the max amount that we can borrow? The bank wants comfort that the money that we're going to lend you will be able to be repaid, based on your current financial position. So there's three main points that we like to look at. Number one, your income. Number two, your expenses. And number three, your liabilities. So income, the bank can take into account, salary or wages and a certain percentage if you have things like commission, overtime, bonuses. If you're self-employed, we can use your net profit and the amount that you pay yourself through the business. And there's also things like border income. So it's just another way to increase your income if you have plans to add a flatmate into the mix of things. Next part they deduct is your expenses. So when we talk about expenses, these are sort of like your essential living expenses such as food, power, transport. But there's also fixed expenses that get taken into account. So things like insurances, just basically regular deductions that come out of your bank account, So we're talking about gym memberships, Netflix, childcare, all of that gets taken as a deduction. Lastly, they take into account your liabilities. So this is if you have things like personal loans, car loans, afterpay, credit cards, other mortgages, etc., etc. So ideally, we want to keep these as low as possible because it does affect how much we can borrow from the bank. For example, if you had a $10,000 limit on your credit card, but you only use it, now and again, you don't really dip into that $10,000 limit fully, the bank still calculates it as if you do use that full limit. So try and keep these sort of liabilities down low just to get the max amount of lending.
Now, I guess there's a few questions I've got for you there. With the income side of things, you touched on borders. Now, that doesn't necessarily mean that you can have 5 borders and utilize all of that income you're receiving, right?
Yeah, correct. So the bank's going to make sure that each border has a room. If it's a couple, they sort of still limit how much we can take into account in terms of border income. But we'll jump into that a little bit later as well.
Okay, and then the last thing you said about debt, credit cards, these limits aspect. So is it important people out there get rid of their credit cards before they go through this process, or can it be done as a condition per se, as like when you find a home, you can actually get rid of it later, you don't have to be rushed into making these decisions?
Yeah, correct. So you definitely don't have to close your credit cards or close your personal loans beforehand. What we can say to the bank is you plan to close it off after settlement, before settlement. And same with your personal loans, we can condition to close it before you actually settle on the property.
Okay, so there are options out there.
Absolutely, yeah.
Fantastic. Now, what really intrigues me is, how banks have varied policies. I think it's the same when you deal with different institutions, but can you elaborate on any sort of major differences between banks? And is there a possibility that you can get a lot more lending at one bank versus the other?
Definitely. I guess banks have what we call a stress test rate. So it's basically an interest rate that is applied in the background to any sort of new lending or existing lending that we have in place. Usually it's around 2% higher than what your sort of standard interest rates are. And the reason why they do that is just from a conservative approach. So, they want to make sure that you can afford your new lending and existing lending at a high interest rate if hypothetically interest rates do get that high, which is, what we've seen in the past. So the stress test rate can vary from bank to bank. Therefore, the lower the test rate, the more money we can get from the bank. So at the moment, it's always changing in terms of which bank has the lowest test rate. Currently, that might be Kiwi Bank. In the future, it could be ANZ, so it's just checking which bank has the lowest test rate to then potentially maximize your lending in that regard. There's also some different, between the banks in terms of how they assess income. So potentially one bank might be able to take more border income than the other bank. At the moment, Westpac, for example, doesn't cap how much border income that we take into account as long as it's realistic and sort of market value. But then there's other banks that cap it at $200 per week, for example. So again, depending if we want to go for that max lending, it's good to sort of hunt around.
Okay, and how about when you're looking at child expense? There's a lot of people out there that will just have kids. How does that affect an application? Is that different between banks?
Yeah, again, changes from bank to bank, and policies always change as well. So what we tell you now could be different in a couple months. But But yeah, some banks test childcare and those sort of daycare expenses differently to other banks because kids are expensive and the way that the bank assesses it is quite significant. It does take a big chunk around how much comes out of our sort of max lending. But yeah, Westpac, for example, have a good way to assess that childcare. But again, that could change in the future. So
of course. So we've kind of gone through understanding the servicing calculation, the differences between the banks. Now, importance of pricing, and this is probably something that you see a lot of push on when you do speak to clients, and a lot of the time it is about pricing. So let's talk about that. Now, how does the pricing work in context of mortgages, and what strategies can first home buyers use to kind of save money in that area when we look at, I guess, loan to value ratios and things like that?
Clients usually fall, especially if you're buying your first home or an owner-occupied property, clients usually fall into a couple of different categories. So whether you have a 20% deposit or a less than 20% deposit. And then so as a reminder, the bank can either lend up to 80% of the value of the property or over 80%. And the main difference between the two is really the interest rates are a big difference, and also how the bank assesses us. So when we are borrowing 80%, we can get discounted interest rates, a good cashback offer, which is sort of the free money that the bank gives you for giving them your business. And the process, generally speaking, is quite simple and straightforward. In comparison, when we are borrowing over 80%, we need to show strong borrowing power to the bank. Cashback offer may be reduced, and because the risk is sort of higher for the bank in a sense that you're giving them a smaller deposit, they add on what's called a low equity margin or a low equity premium. So different terms for different banks. And this is added to your interest rate or loan amount. So typically it's around 0.25% up to 1.25%, depending on what that sort of deposit looks like. So yeah, essentially means that the bank is charging you higher when you put down a smaller deposit to make up for that risk. Just need to keep in mind also that the low equity margin that's applied to your interest rate is not going to be there forever. So when you start to build up some equity within the property and you're borrowing 80% or less in the future, we can do a reassessment and the bank can remove that low equity margin. So then you can jump back down to the low interest rates, have the lower repayments in the future.
So in summary, effectively, if you have a 20% deposit, you've got access to things like cashbacks, low interest rates, and you've got a lot more options in that area. But anything over and above that 20% deposit, whether that's 15 or 10, you might have higher interest rates. You might not get a cashback. And ultimately, you're going to need more servicing power, right? Because you're going to be borrowing more, but you're also going to have higher repayments on that amount of lending.
Yeah.
But ultimately, if that's the only option, you can get in, and then in time, if you do some renovations, pay down the debt, or the property goes up in value over 3 to 6 months' time, you could then reevaluate that. Is it that quickly? Can it happen that quickly? Or will it take a couple of years for someone to be on those high interest rates?
Yeah.
It just depends.
It does depend. And again, it's a little bit frustrating to say this because I'm saying it again and again, but it is different bank to bank. Some can do an assessment after a year, some have a shorter period, some have a longer period. But yeah, who knows what's going to happen with the market? If your property increases in value, that's going to speed up that process to get that low equity margin off. But yeah, if you're going to pay slightly higher repayments, including that small percentage on top of your interest rate, I think it's still worthwhile. You're not paying rent, you're paying your own mortgage. So yeah, long term, you just got to think long term goals and not having that equity margin forever.
Opportunity cost, right?
Absolutely.
If you don't act now, what are the property prices going to be in 12 months' time when you might have that extra 10%? Because I think that's critical as well. So like when we move off that aspect, we're talking about banks a lot. So let's talk about us for a bit. So mortgage brokers versus banks, right? Many first home buyers might be undecided whether to go to a bank or a mortgage advisor. From your perspective, why might a mortgage advisor be a preferred option?
Yeah, for me, it just makes sense to use a mortgage broker and sort of talk through all of your options purely because we're a free service. We don't have any charges or underlying costs. So it doesn't hurt to get a second opinion. If I didn't know anything in insurance or whatever that topic was, and you, for example, were offering your services free, I'd pick your brain. Absolutely. It just makes sense to get as much information as you can from someone that has experience within the industry. Yeah, mortgage brokers, we're not limited to one bank and their, its products and policies. So it allows us to look across the board and figure out which bank is best for us. And, as we mentioned earlier, there's lots of different variables between bank to bank and who can give you the most money or who's better suited for you. Yeah, first home buyers, I think, also naturally have a lot of questions. For a lot of people, it's a foreign process to them. So yeah, we're also there just to sort of answer any questions and guide them through the process from start to finish. And I think lastly, yeah, mortgage brokers can give you more specialist advice. It's not really, we don't really treat you like a transaction where you might get that sort of treatment at the bank simply because they work within their own scope. But we sort of look at your overall goals and tailor the application to you and sort of write notes and commentary based on our conversations that we had as well.
Yeah, so fundamentally, like mortgage advisors get paid by the banks, right, for settling deals. So it's not like the people out there have to pay you for all of this advice, right?
Yeah, and I think that's a big misconception. People think that, mortgage brokers or financial advisor, they're going to cost money, right? But we get paid by the bank, so there's no cost involved.
It's not like you're going to see a lawyer and you have to pay the lawyer for the time, right? You've got access, and you don't always have to go through with the process. We've definitely had clients come in that want to be able to buy, get all the help, but they just can't at this point in time. But it's our job to help educate them and kind of get there as well, right? But other than, I guess, obviously you take that away, it's free for people. We talked about the different banks and how you can potentially get a deal done at one bank versus the other. But there's other things like structures, right? Future goals. How can you help there?
Yeah, so we have a big focus on educating clients how to pay off the mortgage faster. So certain structures will be better suited for certain clients, talking about revolving credit facilities and just really focusing on how to pay off the mortgage faster through their income. And when they got the mortgage, how can we get it down as soon as possible to be able to then set themselves up potentially for their next property purchase. So it's not just like we do the transaction and then say goodbye. We definitely coach you through for the next X amount of years.
Yeah, and I think what's important to understand is that if you understand what the end goal might be for a particular client, it might not just be the first home. It might be paying down debt faster. It might be building a bit of a portfolio. The structure at the very beginning is imperative, right? And it's really important that you get it right the first time. And there's a lot of buzzwords that we throw around, revolving credits, offset facilities, floating, fixed, variable, depends on the bank. Some of these mean the same thing, some of them don't. So it's important to get that sort of knowledge, right? Because you might just go to a bank or in there and be like, I want this lending, they get it, and it's all fixed for 2 years, whatever it might be, but they don't understand that they've got the ability that if they get 10, 15, 20 grand's worth of bonuses every single year, that they could utilize that to kind of offset a mortgage. I think it's something we'll talk about later in another podcast. Anna, thank you very much for all those insights. It's clear that the understanding of the servicing calculations, the nuisances between different banks is crucial for first home buyers in this space. Like pricing strategies, extremely important as well. So to our listeners, if you're still feeling a little bit unsure and your readiness and around can you purchase a first home, remember Wealth HQ side of it, we are here to be able to help in that space. We specialize in preparing you for the home buying process, offering tailored advice and support along the way as well. So thank you very much for tuning in. Don't forget to subscribe for more practical advice and insights on navigating the property journey. I'm Andy, and I look forward to bringing you a lot more helpful content in our next episode. Until then, stay informed, stay empowered, and keep going towards your first home journey. Thank you.
Nice, thanks.